Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman and Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey KNAKAL Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, MUSS Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller. You know, there's a term, attorneys, the counselors, the advisors, these people who are above Apollo. You know, they're the people who counsel. They counsel their real estate clients, they counsel the banks, they counsel everyone. So today, I'm going to provide you with 4 of the nation's top attorneys to provide their opinions of the state of the market, and specifically in the real estate world. My guests today include Robert Ivanhoe, Global Head of the Real Estate Practice for Greenberg Traurig, Carl Schwartz, Head of the Real Estate Practice at Herrick Feinstein, Andy Levy, Co-Chair of the Real Estate Practice for Gibson, Dunn and Crutcher, and last but not least, Richard Fries, the Co-Chair of the New York Real Estate Practice for DLA Piper. Richard, as we were calling you before, you see, these guys are transactional attorneys. You know, they have transactions, which we all know are down. But you have that unique thing. You are, some people might say, closer to a mortician or an undertaker. You handle things which are in a little stress, you know, and there's stress in the market today. What's happening in the real estate market today?
We're seeing some stress. As we say to our financial institution clients and our financial institution clients' borrowers, it's easy to lend the money and it's hard to get it back. Although, as we'll probably discuss today, it's not that easy to lend it right now. But the challenge when loans have been made in better times and when asset values were healthier, when there was more liquidity and less concern.
Is that when you had a beard?
It is when I had a beard, yes. And after that, we worked out a way to avoid some of the stress in the marketplace, which is very significant. And we are, as we speak, anticipating a far worse and deeper period of distress than we did last time.
You know, prior to the show, we were asking each and every one when you started practice. And Andy said that he started practice first in 1969. And we were trying to ask everyone how they look at the market. So in your 39 years of practicing law, how would you look at the market today?
The market today is in a state that I've never seen. I've gone through stressful periods before. Obviously, the 90s and the early 90s was very difficult. There were periods in the 80s. We had hyperinflation then, and we had prime rates in the 20s. There have been oversupply situations, but we have such a systemic set of difficulties now that are transcending anything we've seen in a globalized economy. So things that affect capital flows are coming from the Middle East, they're coming from Asia, they're coming from the United States, from Europe, they're coming from Iceland, where basically the economy is in terrible peril because their banks are out of money. So we see things conspiring to make it very difficult. We also have had some oversupply in certain sectors, and we had actually some enthusiasm about values where people couldn't figure out that values would not go up repeatedly year after year after year. So they were reducing cap rates and buying things based upon expectations that couldn't be fulfilled. So
with regard to that question, you know, your clients who may have bought properties, Carl or Bob, where are values today? What's real estate? Where should it be trading? You know, are we, you know, as Richard Bourne said at an NYU class I recently moderated, he said the hospitality industry is like an abyss.
Here's what's happening. There's not a lot of transactions taking place now. So there's not a lot of trades, and we don't know what the values are. However, the stress that we're seeing, those of us who have been around, which is all of us, we know that what's happening now is opportunities are being created. And we're finding that our clients, as I'm sure all of yours are trying to identify those opportunities, find out where in these much more complex capital stacks the opportunities are going to be, and they're going to identify what the pricing is coming out of this.
But, you know, as one person said to me, if I'm a developer, he said, I got to develop. I have to do something. I'm in the real estate business. You know, I don't have stable assets. I develop. I build a building. So what are you seeing with your clients, Rob, who are developers? You know,
I think
two of them were on my show recently, and they said, "I'm sitting back. I don't know what to do."
I think it's toughest for developers. First of all, if they haven't started a project, to get financing for a development project is virtually impossible. So it's not even as if they have a choice and the option to develop something from scratch. If they have a project underway, and one of the things Andy mentioned, which I agree with about all the changes that have happened in the world over the last few years, but the complexity of transactions is another thing that's changed from the way deals used to be done many years ago. So what you now find is in any large transaction, you have so many different parties that are in the capital structure. And if you're the developer, you have to worry about, is my preferred equity partner going to fund its equity contribution? Is my mezzanine lender going to fund its loan as construction is proceeding? And are all the participants going to fund theirs? And you're only as good as your weakest link.
So now, okay, all the three of you, with the exception of Dr. Death over here, okay, the three of you all have clients, and I mean the other side of the firm has the same type of clients. You have clients today, and I will make the statement, few or no, a very few number of condominiums have been sold in the last couple of months. You know, the market is really dried up on that situation. Mm-hmm. These clients, you know, there are banks who are represented by all of you, but in this situation, Richard works on both sides, you know, where they originate loans and also when there's a workout situation. So how are the banks reacting today in the difficulty that, you know, it's taking longer to close on the loan? You know, maybe they're going to have have renters in the property, you know.
Well, I think one thing that is clear is that the banks have learned that it's in their best interest to, at least if a project is well underway, and unless the loan budget is completely blown up and way out of balance, is to get the project completed, however they do that. And one of the benefits of having these complex capital structures is often the people that end up funding the money where there's a shortfall is the preferred equity partner or the money partner, not the developer. Often the developer doesn't have the money, and it's a lot of projects were undertaken in the last few years where you didn't have the deep pocket New York family.
But isn't that a reality that there may have been clients of everyone here? You know, everyone wanted to be a developer. It was, you know,
it was a good business for a while.
We also work both sides of the fence, representing the lenders and the developers. Yeah. But the theme is consistent. If you're on the lending side, first of all, it gets complicated because of the complex capital structures. We'll come back to that for a second. But if on your lending side, as Rob says, you want to get the job complete. In addition, you want to hold on to as many of the contracts as you still have signed and still might close. So if you take the developer out of the position, you're changing the odds against yourself by doing both of those things. So if your lender is an honest person who has some confidence in building something and can get the job finished on a relatively successful basis, getting it finished, you want to keep that developer in place.
Actually, the lender in many of those cases is actually the equity participant, because values have declined to a point that the equity, which often was very thin in projects that were financed in 2004, 5, and 6, and 7, the equity is gone. And now it's just a question of preservation of value so that the lender gets back as much as it can.
But there is the point is it's about honor and integrity. And if the developer, if the owner, if some of the people in the capital stack that have an equity interest are honorable and have just been a victim of market forces, I do believe lenders are going to stay in the mix, because the alternative for the lenders is so much worse.
But some lenders need the cash. So part of it, there are forces that go beyond a particular project. If a lender is in a position where it needs to raise cash, it has to be, in effect, an equity player selling its assets to raise cash for its balance sheet. And that's part of the cascading problem and series of problems that we
haven't
have.
seen that yet.
There's been a little bit of it. I mean, iStar has been
Yes.
selling some pretty big pieces, and they're involved in some construction loans, and people are concerned that they might start selling pieces of construction loans, future funding pieces, because they don't want to have to keep funding.
But there's another dynamic here, which is because you have tiered debt, the debt doesn't necessarily have a unity of interest. So while the first position might say, okay, finish the job and sell whatever you can, then we'll worry about it because I know that I'm money good. Somebody who's farther down the lending stack might say, okay, I want you to start renting immediately, while somebody below that might say, okay, once you rent, I've got nothing left in the transaction. And so the dynamic among the lenders, it makes it much more complex.
So my question is, so when you have this situation that you have so many lenders, who's making the final decision?
Well, for the most part now, and you guys can tell me if you have different experience, the decisions are not, the hard decisions aren't being made. For the moment, in most of the controversial situations I've seen, the loans are being extended because it's too hard for the lenders to work out among themselves.
And in CMBS, where you have another factor we haven't mentioned, you have loans that go into special servicing. And once a special servicer comes into the picture, then you have a whole new set of dynamics, because most special servicers, no matter what some people tell you when the loans were originated, are not in a position, either because of knowledge or risk avoidance, to make the decisions as to how best to deal with an asset. So you have Freeze again, not Richard Freeze, but you have the other kind of Freeze.
No, but you know that talks about development. Let's talk about another situation. Many buildings, office buildings, were acquired in the heyday of 2006, 2007 at prices that cannot rationalize the numbers today. Good example, office rents today have been quoted that you can rent space on Park Avenue next year, even now, in the 60s and 70s. Buildings were acquired that they needed to get $100 a foot. What's going to happen to your clients who have done that, to your clients who are banks? What's going to happen with that? I mean, your building is a great example. Your building was acquired, what, a year and a half ago by someone? You know, and they were projecting that the rents, because I remember my company was looking at it, that we're going to get $85, $90 a foot. Today, they're not going to get that.
Well, the good news, they have one really solid tenant in Harry Feinstein.
It's paying whatever you're paying.
Exactly. You know, the interesting thing is, Carl, and I did this at a panel today, people, when they signed leases or when the lenders lent money, they lent money to people who they considered a credit tenant. Unfortunately, everybody thought Fannie Mae, AIG, and Lehman Brothers were credit tenants. Right. And so were law firms. But I do remember that there was a law firm that recently went out of business who was a credit tenant, maybe in Times Square. So
there are a few. I mean, our firm has no debt, so we're viewed as a very good credit tenant. But I've sort of developed a thought in the last couple of weeks that in this economy where we are today, there is no counterparty at all that is a sure thing, except the U.S. government, maybe. And the U.S. government's a maybe too, because you never really know. The TARP program was established. It was supposed to go buy assets by buying distressed mortgages to reflate the economy. It changed its mind. There's so much lack of clarity as to what's being done.
I mean, you know,
these are unprecedented. These are unprecedented
Absolutely.
issues.
Yeah, unprecedented
And I think the government is doing the best it can in absolutely uncharted territory. And I think, let's face it, if you go back to that fateful month of September, which comes on the heels of 18 months of subprime. And the 18 months of subprime was nothing compared to September. I think the government has had to try to salvage a financial
I wasn't
system.
making a critical comment about the government. I was just saying that the dislocations are so great and so deep that even the government can't really get a hold on it, and it's working itself through the situation. There are going to be a lot of things that the government will do in infrastructure and other areas to reflate the economy that are going to have great implications for real estate. But in the pure real estate side, they really are lost.
But let's get to the pure real estate side. All of you do transactions. How much office leasing have you seen in the last couple of months?
There's been office leasing. It's slower. The rents are lower, but I think there are deals that are happening. I think tenants, if they have to move and their lease is up, they have to do something. They have to extend their lease or they have to move.
Part of this is supply and demand. When a tenant, just like we were talking before about when assets do move, when something has to happen, it will happen. It may happen at a lower price, and I've heard lots of cases where tenants have fully negotiated leases, and then getting that signature on the page it can be a real drama.
Painful.
It can be weeks and weeks, and people are watching where rents are going. So it's really not easy, but there are deals getting done.
What's happening with retail? What's your thoughts about the state of the retail market? I was with somebody who was supposed to be on our show.
Very ugly.
He said that he heard that 9 retailers have really worked on possibly for filings of Chapter 11 in January.
I think it's pretty universally accepted that after the first of the year, we're going to lose a whole bunch of retailers.
I think one of the concerns that I see about the retail bankruptcies, and I see having to do with bankruptcies, period, is we're going to see liquidations as opposed to reorganizations because there's no capital available. There's no capital available to keep these retailers afloat for 6, 9, 18 months.
I mean, look,
that's
absolutely right.
We've already seen that, with linens and things, and you've seen it with Stephen Barry, and you're going to see it with many more.
Some of them may not even file. They may just liquidate.
Right.
I want to come back to office buildings for a second, though, Michael, because I think that it's entirely possible that the office market can hold on. Because, as you said, most of the high-flying deals were done in the last year, 2 years, maybe 3 years. And unless they lose a major tenant, and of course there are some buildings that are doing that, there's more than a few, there's a number of them, but unless they lose the major tenant and they can't deal with coverage now, there's enough time for the market to come back and to get to the place before these deals mature to be able to keep them alive.
11 and 12 is when the big maturities are.
Yes,
so that's kind of the big day of reckoning is 2011, 2012. When you look at CMBS maturities, that's when the huge number of them mature.
It's going to come back to the banks. It's all going to come back to the banks. Every building has a lender. Every building has a captive lender, and those lenders are going to have to make deals that recognize the market reality.
But didn't that happen in the 90s?
But it's not. The problem is it's not just the banks now, because debt has been diffused through the CMBS market.
It's going to be more complicated.
Very
and difficult.
hard to do that.
If you had one lender like in the 90s where you had Citibank or Chase, and Citibank and Chase was sitting at the table, and they did have some precious capital that they could restructure a loan with, it was a lot easier to get it done than when you have these committees and special servicers and
we have two other factors that I think need to be looked at. One of them is that a lot of loans, because of the intelligence of both lawyers and bankers, have these reserves, these interest reserves that were supposed to be protective of the value of a loan. And all they ended up doing was postponing the day of reckoning.
Okay, so let's get to that subject. There were a number of notable loans that have been discussed publicly on my show, in the newspapers and everything, where there were interest reserves on these properties which may not be able to sufficiently to handle the situation. And as I said prior to the show to the three of you about what rents are going down, even in market, destabilized buildings over there. So if those market rents in some of those properties like Stuyvesant Town, which had gone up to $3,800, which are now $3,000, so they don't even have that, what's going to happen to these large mortgages?
Debt forgiveness. I think no matter how complicated the capital stack is, no matter you don't know who some of the meaningful equity participants are, at the very end of the day, the market has to right size, and it's going to right size through recasting this debt. And we're going to, just like we did last time, we're going to come up with market-suitable structures, whether they're hope certificates, whether they're equity positions.
So you're going to say
one of the things that's going to be problematic is that one of the saving harbors the last time was REITs, and REITs became a great vehicle for people that had
for deleveraging,
deleveraging, strong assets, raising equity. But I think the equity appetite is sufficiently less. And also, REITs have had a very bad period now for the last 6 or 8 months. So I think it's going to take a long time for people to start seeing that as an opportunity.
You know, you all have practices in New Jersey, around the country, around the world. What do you see happening, because, you know, people watch this from around the world and other places. What do you see happening in New Jersey?
I don't think that the devastation, you know, that people talk about in New York, which I don't really believe exists, is being talked about as much in New Jersey.
Well, you think the office market? I've done shows where I've had the largest office owners representing 80% of the space, literally, and I said, the only guy who makes money in New Jersey office, with the exception of Jersey City and Hoboken, is the broker moving some tenant from one building to the other.
It's probably true.
That's the situation. I don't think Jersey is in a great shape. I think the residential market in New Jersey is in the crapper.
The New Jersey office market has been flat for 25 years.
Yeah, but so it's not getting worse.
Okay, but now I'm going to get to another point. You live up in Greenwich. What's going to happen now with all of the hedge funds who are going to be out of business, and the fund of funds because of the Madoff and the other situation, and the Stanford and the Greenwich, all these tenants, they don't need the space. They're not going to be around.
Well, Greenwich is a very interesting micro market where the rents were always way below what they were in Midtown Manhattan, historically, half of what they were in Midtown Manhattan. And then a year ago, because of the influx of hedge funds and their expansion, the rents became higher in far inferior office buildings in Greenwich than comparable rents in much nicer properties in Midtown Manhattan. The air is going to go out of that balloon.
So are we going to see some bankruptcies in the Greenwich area? I mean, there were buildings bought in Greenwich, you know, that they assumed $150 a foot.
There weren't that many of those, Michael. There were a couple. There weren't that many.
I'll tell you one sign at a time. One of the major real estate brokerage firms has a special report just on the movement of hedge funds. It tracks the leasing and the busted leases of hedge funds in office buildings in various places, and that's really a phenomenon of these times.
When the dot-com bubble burst, Rob and I used to talk about this. We thought there was going to be an explosion of bankruptcies, that everyone was going to have to work out those companies, and within months we realized there was nothing there. And all that happened,
but you see, there was nothing to work out. But the other situation is you had other businesses who were continuing to take over for the .com. Now we have a global problem. Okay, we have Soros and everything. The business cycle isn't good. People don't have comfort over here, so it's a difference. Okay, that .com one was a shorter period. You know, it happened, and then they.
But real estate is going to recover as part of the overall economic recovery.
So when is the recovery, Mr. Levy?
I can't tell you when, but I can tell you what I think is going to be part of it, and that is massive addition to the money supply, which is basically going to take care of our deflationary concerns over time, and values will reflate. When, I can't tell you, but in the 90s, when opportunity funds were created, people used to buy debt. They buy it at 42 cents, they buy it at 48 cents, and many people made a lot of money buying at 42 and selling at 65.
So my question, I have the counselors of the world. You represent the major people in the real estate and in the business world. They ask you, when is it going to get better, Carl?
It's hard to say. It starts on Inauguration Day, because that's when the psychology is going to change, and real estate is in large part psychology. It starts when the government starts putting more money into the system so that the liquidity really starts to free up. It hasn't happened, notwithstanding the efforts over the course of the last few months. And we're going to invent something new. Just like CMBS got invented to take us out of the last downturn like this, we're going to invent a new way to make loans and to put the credit on the table.
But then are we going to have the same way as, you know, Michael Douglas said in the movie, greed is good? I mean, the collateralized mortgage debt business were created. There's going to be more greed. Okay,
it'll take a long time for that to reappear. It will one day.
See, I
but
think
it'll
Rob's
take a long
point,
time.
Rob's point about 2011, 2012 is exactly right. There will be opportunity, and it's going to be tied to impending maturities. And as we see these loans come due, you are going to find what I call distressed M&A. And there will be investors that are going to buy that paper when it is necessary to buy that paper.
And that's when it'll clear.
Right.
That's when the
And
system will
it's
clear.
gonna
It's got to
right-size.
clear first.
But okay, I'm not an economist. I'm just looking from the point of view. But I don't see anything really good happening in 2009.
I completely agree.
I think 2009
nothing will happen
is
in
going to be a difficult year. The inauguration will happen. Then there'll be the question of the first 100 days, how much is accomplished in the first 100 days, and if it doesn't happen in the market, all of the cycles. Unfortunately, I have a dear friend who's with Bernstein, and he always says, oh, the market's up, everything's changed. I said, when it goes back to 7,500, it's going to change the other way. So in summation, what's your crystal ball, Mr. Fries? What do you...
I agree with the group that 2009 is going to be a slow year.
It's going to be busy for the undertaking.
It's going to be busy in my neck of the woods, but my neck of the woods is going to create opportunity for 2010, 2011. I think very mature decisions have to be made on both the debt and the equity side to change the capital stack, and that is going to start to free up liquidity, and it's going to start to free up, more importantly than liquidity, transactions. Because transactions are going to be very slow for the next 6 months.
And
a lot of the transactions are going to be done in a different way on the equity side. Whereas before a building would be sold from one player to another, now they're going to be restructurings of partnerships, which are much more complicated, much more expensive, and much more contentious, because you can't just move the asset from one person to another. What you end up doing is having lots of renegotiation, litigation, dealing with lenders, because there's a continuum between the first piece of the debt and the last piece of the equity, and all those players have to be folded into a consensus that makes it work.
Quick comment.
2009 is going to be the year of distress, but we have to hit bottom. It's going to work its way through the system. We'll hit bottom in 2009, maybe in 2010, and that's when we start coming back.
Rob?
I agree. We'll start clearing the system seriously in 2010. And by 11 and 12, hopefully, we'll start seeing some transactions.
I would like to thank the counselors to the world to help me today. I'd like to thank Rob Ivanhoe, Carl Schwartz, Andy Levy, and Richard Fries. Next week, we have the bankers who allegedly will show me the money. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, CUSHMAN and Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey KNAKAL Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, MUSS Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.